you could be in trouble. And even though the nominal value of your house could be rising, you might have to sell it because you might not be able to remortgage it. Monday, May 9th, 2022, Maneco 64, home of alternative economics and contrarian views. Today, we're going to do an update on the UK housing market. We did a video back in April, around April 20th, entitled "The Party is Over for UK House Prices." So this is going to be like a part two, an update. And one thing I would say though, is that according to the Nationwide Building Society, the average UK house price made an all-time high in their previous release. But that's usually what happens when you enter into a correction or a bear market in any market, including the UK housing market. Today, I'm going to use an article that came out in the Telegraph, which I thought was very good. And they're talking about what I was talking about a few weeks ago, almost a month ago. And the fact that the mainstream now is twigging onto this is fairly significant, I would say. So in my previous video as well, I spoke about the relationship between UK house prices and the price of gold. If you haven't watched that previous video, I'll put it up in the cards and below in the description. You might be interested in that, and I think it's very interesting, the relationship between the ounce of gold and the UK average house price. Of course, after we look at this, we're going to look at where the markets are this morning. So the article is entitled "Why You Will Need a £15,000 Pay Rise Just to Get a Mortgage." And I think one of the interesting things that they point out to here is about remortgaging. I always thought that negative equity could be a huge problem for homeowners who have leveraged themselves too much. But this could be the next big thing. It says remortgaging will become unaffordable, leading to forced sales and falls in house prices. So this article is written by Melissa Lawford, 7th of May, 2022. So let's get into it. Buyers will need a 37% pay rise next year to secure lending on the average home as rising interest rates price out borrowers. So again, this is just on the average. So there will be some people who will be hit a lot harder. And of course, there will be some people who won't be affected as badly. Remortgaging will also become unaffordable, experts have warned, leading to forced sales and falls in house prices. So why am I talking about this? Am I trying to encourage people to sell their homes and cash in the profits that they might have made? Well, first of all, you don't make a profit on something until you actually sell it. So there is this fallacy, especially in the housing market, that people say, "Oh, I've made so much on my house. I bought it for 300. It's now 400,000. I've made 100,000." No, you haven't. It's only until you sell it and you cash that profit. The other thing I would say, if you've lived within your means, if you have a steady income, if you're a saver, and if you've been cautious and haven't leveraged too much, haven't borrowed too much to buy a home, you should be all right. And thirdly, if you've been able to get rid of your mortgage, which is something I've been trying to tell my viewers that is a good idea, then you'll be perfectly okay. And Most people, and you will see here in this article, thought that interest rates would never go up, so they leveraged up to here. And now I think they're going to be in trouble. What's the caveat for this? What would change things? Well, if the Bank of England stopped raising rates, if they reversed everything, but then you'd see a lot more inflation, even more inflation, and that would also hurt affordability. But let's continue. Lewis Shaw of Shaw Financial Services, a mortgage broker, said, and I quote him, "A lot of people are going to get absolutely clattered when their fixed rate mortgages come to an end, and there's a big risk that house prices will fall. An awful lot of people will suffer from rate shock. Rising interest rates will make it more difficult to get a loan, with the bank rate expected to reach 3% in 2023. So right now we're at 1%. So I'm not too sure. Maybe the Bank of England will stop at 2, because I think some of the members of the MPC are already getting cold feet. But anyway, let's continue. This would mean average buyers need to earn another $14,800 a year to qualify for a mortgage. The Bank of England increased the bank rate to 1% on Thursday, its 4th consecutive increase. Capital Economics, a consultancy, forecasted to hit 3% by 2023. The bank also warned over the rising risk of recession, which would bring further financial pressure on households. People losing their jobs in the recession, of course. Rising rates will make it difficult for buyers and people remortgaging to meet lenders' affordability criteria. If the bank rate rose to 3%, a typical buyer would need to earn $54,260 to qualify for a mortgage on the average priced £270,000 house. This is for the average UK house. In London, this is much bigger, of course. Or in the Southeast. According to analysis by Hamptons, an estate agent, this 37% more than at the start of this month, when 39,466,000 was needed. The biggest threat to house prices will be the impact on existing homeowners who will get caught out when they remortgage at the end of a fixed-term deal. Buyers who race to lock in 2-year fixed rate deals at the sub 1% rates on offer during the pandemic will be the worst hit, Mr. Shaw said. Well, I also think people who have floating rate mortgages will suffer, but these people will suffer even more because they saw, oh, let's borrow for less than 1%, and they didn't think ahead what would happen. They're going to walk straight from a sub 1% loan to something that is higher than 3%. That's Mr. Shaw saying that. The rate rises will be so large that buyers will see their costs increase even if they have built up more equity in their property. A buyer who took out a £250,000 mortgage on a 2-year fixed rate of 0.9% and a 25-year term will have paid off £18,000 after 24 months. I'll give you an idea really of how things have changed, and I don't mind telling you how I started out, my wife and I. As of now, we don't have a mortgage, so we don't have to worry about it. But I remember in 1996, I had a job that paid me 97 actually, 97. That's when I took a big mortgage. We sold our flat. I had a £80,000 salary in the city, and the house we bought cost $250,000, and I took a £120,000 mortgage to buy that house, and I was very worried at the time. And now I see that the average, I mean, people are taking £250,000 mortgages, and their income is a lot lower than mine used to be. So just wanted to give you an idea of how things have changed. However, rates have already risen to 2.25%, so their monthly costs will jump by more than £200, even though they're only remortgaging 232,000. Only 232,000. I would have had a nightmare if I had that kind of mortgage back then, and I was on a higher income, average, higher than the average now. Monthly repayments will be 1,154 pounds, up from 930. Thursday's quarter percentage point increase in the bank rate has already meant average monthly mortgage payments will jump by 27 to 967 pounds. To counteract this, a buyer will need to earn an extra 1,132 per year. Each increase in mortgage payments equates to a much larger jump in necessary income as banks stress test buyers at higher rates than they actually pay. So there you go, because the banks know what's going on with rates. Is there a possibility, though, that house prices continue to go up on a nominal basis? Yeah, definitely, it could. But on a real basis, adjusted for the rising cost of living, for everything else, you could be in trouble. And even though the nominal value of your house could be rising, you might have to sell it because you might not be able to remortgage it. If the bank rate rises to 3%, buyers in London will see monthly mortgage payments jump by £681. This would mean they'd need an extra £28,585 a year to qualify for a loan. The required salary to take out a mortgage on the average 522,773 property would be 104,845. So much worse for London, of course. In the Southeast, buyers would have to pay an extra $6,084 a year for a mortgage on a 389,266 pounds property. Mr. Shaw warned that even though a 3% bank rate would be historically low for many people in the market, cheap rates are all they have known. There you go. People for the last 10, 15 years, they think that interest rates will never go up, that they will always be low because the Bank of England is ready to basically keep them manipulated near zero. But it looks like that world is changing very quickly. So what I'm going to do here, because you've gotten the picture here of what's going on, I'm going to put a link to this in the description. I know it's a paid for website, The Telegraph, but I have a link where you can get it for free, so you can read it yourself, the whole thing. And this is not just for my UK viewers. This will apply to people everywhere around the world, especially in the Anglosphere, so to speak, where housing has gone up through the roof, the US, Canada, Australia, and New Zealand. So there you go. And before we look at the markets, just wanted to show you another article very quickly, and I'm not going to go through it, but it just goes to show you that it's not just financing your mortgage that's becoming a problem. Look at this. From the FT, UK households resort to buy now, pay later loans to cover energy bills. So there you go. That's the situation. Hopefully you weren't too greedy when those rates were below 1% and thought, well, let's get the biggest mortgage possible so we can make a lot of money on our property. And that's what I always tell people: unless you're in the property business, Your home is your home. It's not a speculation. And yeah, you shouldn't have to worry about the value of your home in terms of fiat currency. It should be somewhere where you live, you and your family, where you have shelter. And that's going to become really important. Shelter, food, and utilities in this coming, I mean, it's getting close to hyperinflation, but it's going to be very high inflation, unfortunately. So let's look at where the markets are this morning then. It's just gone past 8 a.m. London time. It's 10 past 8. Billy and I have been for a walk. It's a nice day out there. Sunny, a bit on the cool side, but I think it's going to warm up later on in the day. So spot gold is down $13 at 1870. Range has been 1886 to 1869. Silver is down 22 cents or 1% at 22.12. So we're retesting the lows we've seen in the last 10 days or so, especially in silver. Am I concerned for the precious metals? No, I think that's the best financial insurance to have outside the system. And right now, what I see happening is some kind of liquidity crunch. So people sell everything, including paper, gold and silver. But you can be sure that it's very hard to get, or very expensive to get silver. You can't get it for 22.14 or whatever the price is, around 19 pounds here in the UK. So I'm holding on and I will keep stacking silver, especially because it's very undervalued. The Dow future is down 2/3% or 200 points at 32,700. The NASDAQ 100 future is down just over 0.5% at 12,620. S&P is down 28 points or 2/3%, just below 4,100. FTSE is down 24 points at 73.86. Eurostoxx 50 is down 2 points, 36.23. To the currencies, yes, and the dollar continues to strengthen. Does that mean the dollar will be the place to be eventually? No, I just think the dollar is the best of a bad bunch of all the fiat currencies. And right now, with the liquidity crunch, seeing that the dollar is the major reserve currency, when people liquidate a lot of assets, they go to the dollar just because it's there. Eventually, holders of dollars will realize that it's just a debt instrument. And with the bond markets continuing to implode and yields continuing to rise, I don't want to be in the dollar. I want to be in gold, silver, and commodities and hard assets. It's going to be like the 1970s. Anyway, sterling is down 0.5%, 122.77. The euro is down 1/3% at 105.12. And the dollar is up 0.5% versus the yen, 131.17. Dollar is also up 2/3%, quickly moving higher versus the yuan at 675.80. And the dollar is up 0.4% versus the Swiss franc, almost at par, actually. The Swiss franc was stuck around 92, or the dollar was, for many, many months or years. And we're now at 99.23. Just to give you an idea about gold, gold is still up 4.2%, around 4% year to date versus the dollar. So gold is actually outperforming the dollar year to date. To the other currencies, Aussie dollar testing the 70 level, down almost 1%. The dollar is up 0.2% versus the Canadian dollar, 129.31. And the Kiwi dollar is down 7/8% at 63.50. To the general commodities, WTI crude is down 1% at 107.80. So if you look at the other currencies, the non-dollar currencies like the pound and euro, with them going down so much and oil staying up relatively elevated here, that's going to make energy prices, natural gas prices, utilities go up even more. So there's no let up in the cost of living crisis, I would say. Brent crude is trading at 111, down just under 1%. High grade copper is at 420, down 1.8%. Natural gas up 1.4%. US nat gas at 8.17. And now to the probably the most important indicator for all financial markets worldwide. That's the US Treasury market. And this morning, we are at 314 in the 10-year yield. It's up 2 basis points. It's been up to 316. And I'll show you a chart of the 10-year yield going back to around 2018, end of 2017. And you can see there back at towards the end of, well, October, November 2018, we got up to around 325 intraday. And that's when the Fed had to start reversing everything. Eventually, we had the 2020 crisis. The Fed started doing QE again. So we are at a critical juncture here. We're at 314. I mean, we could be at 325 this afternoon. So more fun and games. Things are getting quite interesting. And yeah, if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to this channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.